Hello, everybody. Welcome back to the DFREE Wealth Lab. If you've been here before, we welcome you back. If this is your first time, you picked the right time because we have a guest whose information is dynamic, whose personality is charismatic, and she's just a great person. But before we go there, let me remind you that we call this the Wealth Lab because in a laboratory, we do research and we experience discovery. So, for a wealth lab, we're researching strategies to create wealth and we're discovering ways to leave a financial legacy. Don't get it twisted. DFREE does not simply mean debt free, although today we are going to talk about student loan debt. But getting out of debt is just the first step towards creating financial freedom. And that's why we start with debt, but that's not the end. That's just the beginning. You can leave comments, ask questions along the way while our presenter is speaking. You can put into the chat and you'll get answers quickly, or you'll get referred to people that can answer your questions. Now, I want to introduce our presenter. I was in Mississippi some months ago, earlier this year, and I met this young lady who not only works with Prudential, but she has her own agency. She's an entrepreneur and a financial professional, and she absolutely blew me away. Then I came back to Mississippi, and not only did she listen to me, but I listened to her. She is a passionate freedom fighter, financial freedom. She's a mother, she's an activist, she's a believer, and I just absolutely love her and expect you to have life-changing information from this presentation. Welcome to the DFREE Wealth Lab, Ashley Hentz from Mississippi. Ashley, welcome.
Hello, thank you.
So, Ashley, I'm going to turn this over to you and we'll answer questions along the way. I appreciate you coming and I'm sure you'll do a great job. God bless you.
Thank you. Thank you, Dr. Soris. Well, hello, everyone. Like Dr. Soris says, my name is Ashley Hentz, and I do work at Prudential Advisors by way of Edison Magnolia and Company. Today's presentation is on student loans, how to pay off your debt. Please note that the material presented today will be general in nature and should not be relied upon as the basis for action or inaction by you, of course. At the end of the presentation, I will be glad to answer any questions you may have. So let's get started. Before we begin, the opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities or insurance products may be required to effect some of the strategies. Investing involves risk, including possible loss of principal. To determine which investments or financial strategy may be appropriate for you, consult with someone like myself, a financial professional, prior to taking any action. Prudential, Prudential Advisors, Edison Magnolia and Company LLC, and LPL Enterprises, as well as LPL Financial, do not provide tax and or legal advice or services. Please consult your tax and or legal advisor regarding your specific situation. All right, nearly 6 in 10 college students graduate with debt owing and on average $28,400 per graduate. To begin, let's take a quick look at the landscape of student loan debt in the United States. Among the class of 2020, 55% of bachelor degree recipients took out student loans, graduating with an average of about 28,400 in federal and private loan debt. And that's a lot of money. Americans owe nearly 1.75 trillion in student loan debt. spread out among about 46 million borrowers. That's about 440 billion more than the total US auto loan debt. Student loan debt is impacting financial wellness and the ability to save, buy a home, and socialize with others. 42% of graduates still pay student loan debts to this day, saying college costs has caused them to delay buying a home. And a lot of us have that experience. By contrast, only 12% of those who never took out student loans voiced this complaint. More than half of the graduates still paying down their student loans. 55% say the cost of college has prevented or either caused a delay, saving them from emergencies. By contrast, just 9% of graduates who never took out student loans report this problem. Student loans, how to pay off your debt. So today's agenda is clear. When it comes to paying off student loan debt, there are three crucial questions you should be able to answer. And this is what we'll cover in today's seminar. First, what type of loan do you have? Second, what are your repayment options? And third, what's your payoff strategy? First, it is important to understand that the type of loans that you have, do you have a federal loan or a private loan? And what's the difference? Next, you'll want to understand all of the available repayment options so you can make an informed decision and develop a repayment strategy specific to your individual goals and needs. Types of student loans, and there are several types of student loans that we will discuss. But specifically, there are two types of student loans: federal loans and private loans. Federal loans have several benefits and are generally less expensive than private loans. Therefore, as a borrower, you should take advantage of these loans before seeking private loans. Let's take a look at some of the major factors that differentiate the two types of loans. Federal loans funded by the federal government, low fixed interest rates, subsidized interest, flexible repayment options, and they offer forgiveness programs. Whereas a private loan, they're usually backed by banks, credit unions, and state agencies, variable and generally high interest rates, meaning that they fluctuate, and repayment options depend on lender and terms of the agreement. And so here, federal loans are funded by the federal government. The interest rates on these loans are typically lower than the private loan. And private loans can have variable interest rates, some as great as 18%. As a result, this can impact your ability to repay that loan. Now, repayment of these loans, for federal loans, there are several federal options. So they have flexibility, and you can even defer or go into a forbearance. Those options are available. And we'll take a more detailed look at these options a little later. There are also forgiveness programs available for federal loans. Repayment on private loans depends specifically and strictly on the terms of the agreement. And it is quite unlikely that your lender will provide any loan forgiveness program. You may also be required to make payments on student loans while you're still attending school. Controversially, federal loans you do not pay back until you graduate. All right, federal loans at a glance. So here we have four types of direct loans available. Under these programs, the U.S. Department of Education is the lender. So you have direct subsidized loans, and the eligibility for that loan is undergraduate. And you have to have a need, of course. The interest rate is typically 5.50%, and the annual award is up to $5,500. Then we have direct unsubsidized loans, and they are eligible for undergraduate, graduate, and professional students. But eligibility is based on your financial need. Now, then we have direct plus loans, and these loans are made to graduate and professional students and parents of dependent undergraduate students. Now, the eligibility on this is based on financial needs, but a credit check is required. Then we have our direct consolidation loan. This allows you to combine all of your eligible federal student loans into a single loan with a single loan servicer. And we'll take more about that in a minute. There are varying interest rates for all of these different types of loans, but specifically the Direct Plus loan, there is a maximum annual award. So that Direct Plus loans, they're different because there is no cap. You can borrow as much money as you need to pay for your education, which is the benefit for the Direct Plus loan. But like I mentioned earlier, it is based on your credit. And so, in order to qualify for as much as you need, your credit also has to be sufficient. The amount you can receive is equal to the cost of attendance minus any other financial aid you have received. So if you see here in the COA for Direct Plus, if you go down to your annual award, it says COA. That stands for cost of attendance. And so that is what determines the amount that you would receive, and this chart provides a high level snapshot of that, but there are more details on the Federal Student Aid website if you want to discuss it further or read more up about these four different options. Now, I must note loans made through the Federal Perkins Loan Program, often called Perkins loans, and that is not listed on this slide, but they are low interest federal student loans for undergraduate and graduate students with exceptional financial needs. Under federal law, the authority for schools to make new Perkins loans ended on September 30, 2017, and the final disbursements were permitted through June 30, 2018. And as a result, students can no longer receive Perkins loans, which is why it's not listed in this chart. A borrower who has received a Perkins loan can learn more about managing it at the federalstudentaid.gov website. And so that would be your resource. All right, federal loans, repayment options. So, borrowing for your education is definitely an option you have if you don't have proper savings to pay for school or you have don't receive scholarships. So, of course, you have to borrow money to pay for your education. And borrowing can dramatically over the years change the trajectory of your life. Also, changing is the way students can repay for their loans. So, these programs are constantly evolving to meet the times. And so, federal loans have many flexible repayment options to make it easier for students to tackle repayment on their loans. So, let's take a look at four repayment options that are available. Standard repayment plan. That's option number one. Graduated repayment plan. That's option number two. Extended repayment plan. That's your third option. And income driven repayment plan. And guys, this is all that you have available to choose. Now, your standard repayment plan, let's go a little deeper. This program will pay off your student loans the fastest and with the least amount of lifetime interest compared to the other three repayment options. under this program, you have up to 10 years to repay. So between 10 and 30 years for direct consolidated loans and FFEL consolidation loans. Now, all borrowers for this plan are eligible. Now, payments are fixed. So you have a set monthly payment. It does not change. And you see payment type fixed, a minimum of $50. But then you have the repayment period that's up to 10 years, as stated. And then, of course, it's eligible for all borrowers. This is the repayment plan your servicer will automatically place you in. And let me repeat that, automatically replace you in. So if you're interested in any of the other repayment options discussed, you will have to take personal action. All right, let's go to the next one, graduated repayment plan. So, this one is a good plan to consider if you know your income will increase over time. So, if you've graduated, you've gone into your profession, and there is a bonus structure, you know that as you advance in your education and in your career, that the increase will come from your payments, then this is a good option for you. However, you will end up paying more for your loan over time because due to interest, of course, and then it's not a standard repayment plan, which has a fixed term. All borrowers are eligible for this plan, of course, and the repayment will start out low. So you will have a very low payment in the beginning, but they will increase every 2 years. Paying more lifetime interest on this loan compared to the standard repayment plan is the only caveat to this program. Let's go to our next payment plan, which is our extended repayment plan. Okay, so this is fixed or graduated, meaning you can have a set payment or it can gradually increase over time. The extended repayment plan does just that. It extends the period that you have to repay the loan, which can be up to 25 years, and you have the ability to stretch out your repayment period. So your monthly payments will be greatly reduced compared to your prior plan and those prior plans that we have talked about. However, since you are extending the life of this loan, you will end up paying so much more than you would in the 10-year standard repayment plan. And that is something to consider. Now, this eligibility requirement is for new borrowers with over $30,000 in outstanding direct loans. And the final option you have is an income driven repayment plan. All right, so income driven repayment plan, which was the option I chose when I had student loan debt. This allowed me to pay based on the percent of my income. So the income repayment plan, which is my personal choice, ensures affordable payments based on the percentage of discretionary income. And so it's capped for like a 10% of that loan received, but this only came into effect after July 1, 2014. So the payments are based on your current income and can be reevaluated every year. So when I first started in my career 20 years ago, I was only making about $40,000 a year. And so my payment was based on that percent of income. And then the payments were gradually increased based on my income as I evolved in my career. So the repayment period is typically 20 to 25 years. And I've been in this industry for 20 years, so we're at the very end. We just actually paid those student loans off, which is a wonderful, wonderful experience just to know that you don't have that debt on you anymore. And you have an option to have some funds forgiven. So, one of the main benefits is that any outstanding balance after the repayment period may be forgiven. However, that amount forgiven is treated as taxable income. meaning it will report on your taxes as income earned in that year. There are four types of income driven repayment plans, which we'll take a look at in the next slide. And for federal student loans that are eligible for at least one of these plans, we will discuss those next. All right, so here are them, the income driven repayment plans at a glance. So you can pay as you earn, savings on a valuable education, income based repayment plan, and the income contingent repayment plan. This slide shows you four income repayment options and the percentage of your income that is generally used for these payments. Okay, so for the IBR plan, you are considering a new borrower on or after July 1, 2014. And if there is no outstanding balance on a William D. Ford direct loan, then you are eligible for this option. So generally, 10% of your discretionary income, but never more than 10 year standard repayment plan amount is the pay as you earn option. And they summarize it as the PAYE. And then you have your savings on a valuable education. So the SAVE plan calculates your monthly payment based on income and family size. And we'll replace the revised pay as you earn. So the REPAYE plan. And these acronyms are all available on the website for you to get more information on. But then, of course, you have finally your income contingent repayment plan, your ICR, the lesser of the following. So, 20% of your discretionary income or what you would pay on a repayment plan with a fixed payment over the course of 12 years. And this is accordingly adjusted to your income. Okay, so I'm going to give you an example of an income based repayment plan. This chart shows you how the IBR income based repayment plans might work in the first year for a hypothetical scenario where an individual, one person household with an adjusted gross income of 40,000 a year. So we could say this was actually 20 years ago. So this example assumes this person is living somewhere in the 48 states or the District of Columbia, where the poverty level for one person household is in 2016 is about $11,880. So that's B, poverty level. Okay. She has just graduated with $80,000 in student loan debt, bearing an interest rate of 6%, which is quite a bit high. And her income will increase 5% annually. So in this scenario, we have discretionary income for C and D. And then we have 10% of discretionary income, which is D times 0.10, which is basically times 0.10%. And so that brings you to $2,218, which is roughly $185 a month. So the annual payments under standard 10-year plan is about $888 a month, totaling $10,656. So here is an example of what that plan would look like and how those numbers are calculated. All right. So another option that you have, and many people have used this option, this is the federal loan consolidation option. So they have available another option for borrowers. This will centralize all of your borrowed student loans into one bill, resulting in one monthly payment, and it will go to one servicer rather than having multiple loans in multiple places. And so there must be a loan grace period and a repayment period. However, before signing up for a loan consolidation, it is important to fully understand the details. And that's sometimes where we make mistakes. We don't read the fine print, but we must, because not reading that fine print will result in consequences. For instance, once you consolidate your loans, they cannot be separated. So they're brought together in a large pool. You cannot break them apart again. And so some people assume that when they consolidate, they'll get the lower payment, but then later they can break them off. Unfortunately, in a consolidated loan situation, that is not an option. Also, when consolidating, your interest becomes the average of all the loans. So you would not be able to target payments to a specific loan that, for instance, had a higher interest rate than another. So everything is averaged out. And that is one of the reasons why you must read the fine print before signing paperwork. All right, so as I mentioned earlier, another benefit of federal loans compared to private loans is the forgiveness option and the cancellation option. And of course, we all want to know more about these options available. These are the two most common types of forgiveness, including public service loan forgiveness program and the teacher loan forgiveness program. So, for public service, loan forgiveness program. It began in October of 2007, and I am an October child. For those who work at certain public service jobs in the government and nonprofit organizations, you are eligible because of the 501c3 status, meaning that only direct loans can be in this program. You work full time at certain public service jobs and you made 120 payments under an income driven repayment plan. So, those three things have to be met in order to qualify for loan forgiveness, and they will completely bring it to a zero balance. Now, for the teacher loan forgiveness program, the requirements are you must teach full time for 5 consecutive years. And this education adventure must be at a low income elementary or secondary school or educational service agency. And up to $17,500 of subsidized or unsubsidized loans may be forgiven. Now, there have been a few updates to the Public Service Loan Forgiveness Program effective July 1, 2023. And that was during COVID. And so, if you want more information about those updates, visit studentaid.gov and they will have that information for you. All right, federal loans. So we have deferment and forbearance, and we want to know the difference in the two. So, under certain circumstances, you can receive a deferment or a forbearance. And this allows you to temporarily postpone or reduce your federal student loan payments. Now, postponing or reducing your payments may help you avoid default, but they do not stop the interest on the loan. If you can't make your scheduled loan payments, but you don't qualify for a deferment, your loan servicer may be able to grant you a forbearance. And so, with the deferment, it's for students returning to school, unemployed, or on disability. And you can defer up to 3 years. And the interest still accrues on unsubsidized loans. Now, the difference is the forbearance option is temporary. It temporarily postpones for up to 12 months. Interest continues to accrue on subsidized and unsubsidized loans. There are two types of forbearance. You have a discretionary forbearance, and that's where lenders decide whether or not to grant your application. And then you have a mandatory forbearance. And if the criteria is met, lenders are required to grant your forbearance. Okay, so these repayment strategies, I mean, there are so many. But first thing, we have to get organized. Being organized is the key. By creating a spreadsheet with all of your important loan information, you are able to better devise a strategy to pay off your debt. And this is where we come in. Financial professionals are able to sit down with you in this spreadsheet to determine what's your best next step. Also, consider setting up an automatic payment plan. That way, the payment is never missed or late, and it automatically comes out of your account at a set time. And we want to avoid late payments and missed payments because the interest is earned on that, and you accrue fees and charges, and proper money management avoids those things. Also, many lenders may even reduce your interest rate if you set up an automatic payment plan as one of the incentives. Now, if we try the debt snowball method, this refers to paying off the smallest balances first and working your way up. Conversely, debt avalanche is the method of focusing on high interest debt first. So you could either choose the snowball method where you start small and you take small pieces and it gradually increases, or you can do the avalanche method where you start big and you take smaller bites on your debt. Now you may want to consider paying off your loan first because they typically have greater interest than any other flexible repayment plan with the federal loan. Now, there are tools available, student loan repayment calculators. These tools allow you to estimate your repayment periods and the impact of different repayment strategies. If you want to learn more, we do have additional information about the debt snowball and the debt avalanche. Now, repayment strategies that I encourage: pay extra. Make more than the minimum payment, but know how it's being applied. When you make more than the minimum payment, of course, you can call and specify if it's an interest or principal payment. Do not advance the due date. By advancing the due date, you recalibrate the system, and this could create more payments for you. Stick to a budget. Paying off your student loan debt on a starting salary may require some sacrifices. If your goal is to pay off your debt as soon as possible, there are strategies available and you can make more than the minimum payment. But it is important to understand how extra payments are applied to your loan. Every lender is different, but in most cases, the extra payments may be applied first to interest, not to the principal. Therefore, depending on your strategy, it is critical to understand and communicate with your lender. If you specify having that extra money applied to your high interest rate loans first, you may save hundreds of dollars or more in extra interest payments, potentially getting out of debt faster, which is the purpose, the goal here. In some cases, if you overpay on your loan, the lender will push that next payment due date. Make sure you continue to make payments monthly. Or, in addition to those additional payments you made, take advantage of all of the benefits. If you want to make additional payments, it may require cutting back on your spending. Let's see, take a look at your monthly expenses. After you've covered all of your fixed expenses, that's your mortgage, your utility bill, car payments, daycare, all of those expenses, how much money do you have left over at the end of that month? Can you afford to make an additional payment? Is there anything else you can cut back on to do so? If you can answer yes to any of these questions, revisit your spreadsheet and create a budget for yourself and stick to it. Sticking to that budget will allow you to continue this strategy so that you can eventually have your loans paid off. Now, another option that you have here is refinancing your private loans. So, refinancing your private loans is similar to refinancing your home or refinancing your car or any type of refinancing efforts that you have maybe considered in the past. This option is available for private loans. And the reason they are available for private loans is because these are bank backed, credit union backed, or financial institution backed loans with high interest rates. So it may be beneficial for you to refinance that loan to receive a lower interest rate. And I'll give you an example. Let's say when you first applied, you had very little income and your credit was low. Several years later, you have graduated from your university or your college, your income has increased, and your credit is a lot better. This may allow for a lower interest rate. Therefore, you'll end up paying less over the lifetime of that loan. However, there are a few requirements to qualify. You must have good credit. You must have steady employment and favorable debt to income ratio. And we'll talk about debt to income ratio again. Recent college grads may first need to build their credit before refinancing becomes an available option. Now, continuously making timely payments on your loans will help. Also, use a credit card as opposed to your debit card. And this is something that we have been talking about for generations. Use a credit card before using your debit card for your purchases and paying it off in full each month from your checking account. Debit cards do not contribute to your credit history. All right, repayment strategies. Check to see if your employer offers student loan assistance as a part of their benefit offerings. Many employers are beginning to add student loan assistance programs to their benefit offerings. These programs can help you create a plan for managing your monthly payments and eventually paying off your debt. And they typically also provide an option for the employer at their discretion to make payments to help you pay down your debt. So definitely ask your HR department if your employer has any such programs for you and they are offering them immediately. Okay, so repayment strategies. Ask your accountant. So, as a financial professional, I am not an accountant. You may be able to take advantage of some federal tax deductions on qualified loans. And so, here you see on Form 1040, Schedule 1, this is a snapshot. And down to number 21, there is student loan interest deduction. This may be included in your tax returns each year. And so this is from publication 970 on the IRS. You can visit that at any time. Okay, so repayment strategies. And here is where your financial professional can help. Consider life insurance. What? Life insurance. Yes. Federal loans discharge due to death. If something were to happen to you, would your family be able to pay your loans? If not, federal student loans will be discharged to death of the borrower or of the student on whose behalf a plus loan, key there, plus loan was taken out. Parent plus loans will be discharged if the parent dies. So if the parent dies, your parent plus loan is discharged. If you die and you have a plus loan, it will be discharged if you die. But in the event of the borrower's death, private loans are not often forgiven. So federal loans are discharged, but private loans are not often forgiven. And the borrower's cosigner, estate, or spouse could be held accountable for that repayment, which is why having considerable amount of life insurance and including the value of this debt is beneficial to your legacy. Life insurance could provide your family the protection it needs to continue that loan repayment or even pay it off. Now, these resources are available at Federal Student Aid, federalstudentaid.gov, studentloans.gov/ my direct loan / mobile repayment estimator. This website you can use and visit at any time. All right, so this is the end of my presentation. Thank you so much for attending. Student loans, how to pay off your debt. Any questions?
I have a question. Do you realize that you sound like you from Mississippi? Oh
I
Lord,
am
folks.
definitely a Mississippi native.
Folks, you heard it straight from Mississippi. She is just as wonderful a person as she sounds and seems. So, listen, we advocate for the snowball debt payment method also. And for those of you who are involved in the DFREE program, it's in your workbook. We describe the difference between the snowball method, the avalanche method, and it's your personal choice. And actually, you did such a great job describing student loans. It's a complicated subject, and it gets more complicated because the government keeps changing the rules. But I think
Yes.
the public service debt program is probably the one that will last the longest. That's just my political perspective. And I'm celebrating with you the fact that you paid off your student loans. So, folks, if you have questions, ask questions. Go to the dfree.com website. We have information on student loans. Of course, Say Yes to No Debt. My book and workbook have information on paying off debt. And I appreciate Ashley being with us today. Until next time, we'll see you. If you heard something that sounded more complicated than you were able to take notes about or comprehend quickly, just rewind. Just rewind and listen to it over and over and over until you absolutely understand exactly what we're saying. But Ashley did a great job. You spoke very carefully, clearly, and slowly, and I appreciate you and your time. And we'll have you back again to talk about another important subject on the DFREE Wealth Lab. So thanks to my team. Thanks to all of you. God bless you. Till next time, you pray for us and we'll pray for you.